Welcome to the Startup Help Desk. We are your source for answers to questions about starting companies, building companies, and the meaning of life. We have a panel here of experienced founders and investors, and a series of questions asked by people just like you on our website, thestartuphelpdesk.com, or on X/Twitter at thestartuphd. Questions really about building businesses, starting companies, and all those sorts of things. We'll jump into it today and introduce your panel of answerers. I will get started. I am Sean Burns. I've been a founder for about 20 years of companies like Flurry and Outlier. These days, I'm a venture capitalist. I started a firm called Near Horizon last year with a somewhat unique model of partnering with solo founders to realize their business, where we jump in and become part of the team. And we'll talk about that more in today's episode. But before I do, let's meet the rest of our panel, Nick and Ash.
Hi, everybody. My name's Ash Rust, and I'm a pre-seed investor based in San Francisco. I mostly invest in B2B companies based in the US and UK through my fund Sterling Road. And I've also worked at places like Trinity Ventures as an entrepreneur in residence and Bullpen Capital as an advisor. Before investing, I was an entrepreneur myself, most notably an early employee at the social media analysis company Clout, as well as the co-founder and CEO of SendUp. These days, I spend most of my time coaching founders, and I've helped more than 1,500 startups over the years.
Hey, this is Nick Melionis. I'm co-founder and CEO of a startup called Navi. Our thesis is that the skills that make the best founders are the same skills that everyone needs to succeed in the world of tomorrow. That skill set is the innovation skill set. In short, we help people and organizations start and succeed on their innovation quests. I've supported hundreds of innovators and startups along the way. And in usual fashion, I'm excited to get into today's questions.
And Nick is the only member of this team. We're all founders. We've founded companies and bought companies and sold them. But Ash and I have gone over to the dark side of venture capital. Nick, you are still holding true in the founding position, which we greatly appreciate.
I got to do it.
I'm out here adding value. Everyone else is an evil VC.
But we do get a lot of questions about VCs and venture capital. A lot of startup companies do try to raise venture capital, and not all of them are successful. We get a lot of questions. And so today our episode is all about founder-friendly venture firms, specifically new kinds of venture models that people are pursuing to try to give founders different options in a world of venture capital. Both Ash and I have these sorts of new funds with different kinds of models, not like traditional venture funds. And today we'll jump into those and how they can be options for you in building your business. So Nick, start us off, man. What should we talk about when it comes to founder-first venture capital firms and these new kinds of models?
Yeah, let's do it. So as mentioned, the theme for today is the first of their kind venture funds. We're looking at Near Horizon and Sterling Road. And in short, what we want to be able to unearth is your new take on what constitutes a value add VC. To kick things off, let's start with some brief intros. Sean, we'll turn it to you first. Do you mind providing a quick intro into Near Horizon and what you all are all about?
Yeah, so Near Horizon is a very new firm. 3 partners. All of us have been founders of successful companies over the past 20, 30 years. We partner with mid-career solo founders. So somebody in the middle of their career, maybe a decade of experience or more, has a really good idea, but doesn't have a natural co-founder. We jump in, we invest both in the business, but we also jump in and join the founding team. So our partners become the founding team. We do everything from customer research to product design, build. We design ML models, and we help with the early go-to-market. So we're an alternative to finding that co-founder for people that have a lot of industry experience, a lot of knowledge, a lot of network, but don't have that natural co-founder fit. It's kind of what we call venture building, where it's a combination of not just capital, but us jumping in and doing the work.
It's fantastic. Ash?
Yes, so like all good venture firms, Sterling Road is both different and founder-friendly, of course. Our premise around that is that we are focused on founder coaching. So I work with founders at the formation stage, usually when the company is just getting started. Maybe they just incorporated or just went full-time. We're going to work with them every couple of weeks for 30-minute meetings in these coaching sessions. That usually goes on for at least 3 months before we do 6-figure checks. Sometimes we do smaller 50K checks in advance of that. But we're going to do at least 3 months of coaching before we do a 6-figure check. And a large part of what we do nowadays is actually helping founders based in the UK come to the United States and build a business.
Got it. Yeah, it's a great situation. So, of course, one of the themes that we've all been discussing is around value-added VCs. And so this first question that we got from a founder is themed around that topic. So the question is, how involved should a typical VC be? And specifically, what does real value look like when a venture capitalist is contributing meaningfully to a startup? Ash, do you want to kick things off here?
Sure. So typically the answer is they're not going to be valuable at all. In fact, oftentimes they're going to be a negative. Most of the reports that you get from people about their board members is that they are difficult to deal with, not particularly helpful, and add extra work. That's obviously not an ideal situation. So let's look at the positive. Where do VCs tend to help when they do help? So it might be around inflection points. Maybe those are things like legal issues, business development deals, acquisitions, those kinds of things where their counsel, network, advice, legal help, these kinds of things, other infrastructure might be a real value add. Another piece is the regular cadence of coaching. That's obviously what we do at Sterling Road. Something that a lot of other VC firms do is help on the hiring front. Others help on customer introductions. Many larger firms, maybe if they've invested in thousands of founders, like or Y Combinator, they're going to provide you with a really great community. And then a lot of people, obviously, because their network is within the VC community, they're going to help you with fundraising. So those are the sort of 6 or so points at which a VC can add value. Be wary of people who say they can help across all of them unless they've got a pretty big organization. Usually people are going to be specialists on 1 or 2 of those. And if they don't have anything in particular, then they're probably not going to be good at any of them.
President company excluded, of course, obviously.
yes, all those caveats. I put those in the disclaimer, so the editor's going to put those in right at the beginning. So
You'll have to find that in the episode notes, but it'll be in there.
It's left as an exercise for the reader.
I agree with what Ash said. I would actually go a step further, though. I think a lot of VCs promise to help you, and many of them will not do anything meaningfully to help you. But that's not necessarily a bad thing, because I would think many of those firms, if they tried to help, would probably do more harm than good. And so other than using their networks to maybe get you, potential job candidates or maybe potential customers, or especially the investors for your next round of financing, you probably want your investors to do as little as possible. You don't want them jumping in. Many of them don't have operating experience. If they do, it might be not super recent. And so I think you're better off. Our model, obviously, at Near Horizon is very different. We're joining companies at the formation stage, a solar founder. So we're jumping in and doing a lot of the work from 0 to 1. But honestly, the only reason our model even works is that we have a partnership of founders who have been doing that for decades. And we've done the 0 to 1 thing countless times. There are very few people, I think, with our kind of experience who even want to do that kind of work anymore. And so what makes us stand out is, frankly, in some ways, just that we enjoy doing that work and want to keep doing it. But the people who the investors who you want to jump in and help, Ash and me notwithstanding, often don't want to do that work anymore. And the ones who do probably do more harm than good. So you're better off, frankly, with the investors who promise a lot and do little, because the inverse isn't great. Except for Sterling Road and Near Horizon, which you should definitely work with because they definitely do a lot of good stuff.
Yeah, I couldn't agree more on that front.
We're really painting a rosy picture here.
And we are not biased at all. It's all completely unbiased.
This is all about objective winning advice right here. There's no doubt about that. So it seems that there is a key theme here where really, in terms of Near Horizon and Sterling Road, it's this process of getting involved early. And as part of that for Sterling Road, you've got this process of coaching months in advance of actually deciding whether you're going to work together long term. And then for Near Horizon, this process of being there as a co-founder for the startup. These are, in short, first of their kind type of investment models. How are the results in terms of what you are seeing thus far?
I'm normally a very confident person. I will confess to you, I was very skeptical that our model would work in Near Horizon. And partly why we started it 18 months ago, and we don't yet have any LPs, it's all our personal capital going to fund, is we weren't sure if the model would work. I mean, there's a lot of ways to believe that having investors jump in like we do and become part of the founding team would not work. You might have selection bias where you attract the less compelling founders or the less likely to succeed. You might end up doing too much for them, and in doing so become a crutch instead of a booster rocket. But honestly, over the last 18 months, I've been surprised. The models worked better than we could have hoped. The companies that we've worked with are off to the races. And so I have been pleasantly surprised. And I think we're doubling down on Near Horizon now as something we want to work on for the next decade based on that success. Of course, venture is a world that's measured in decades. And so it'll be 10 years before, the results of the fund dictate how well it worked. But for the founders we're working at and the companies we're working with, it certainly has worked quite well early on. But I think one of the things you mentioned, Nick, is important to mention. We work with companies at formation stage. The longer the company goes on, the bigger it gets, the less likely anybody can help you. So we can jump in and help at the formation stage, but by the time you're a Series A and Series B stage company, I don't care how much your investors want to help. There's very little they can do.
Ash, do you want to give a shout out to just early signals that things are rocking at Sterling Road?
Yeah, sure. We're very fortunate. We have a public company that we've been going for about 7 years now. Multiple companies that are worth 9 figures, and in general, it is a very helpful mechanism to find founders in places outside Silicon Valley and then bring them to Silicon Valley. That's going to be just a pricing arbitrage. Most of the way it works in venture capital is that you get 1 or 2 funds on a good idea, but you don't usually get a third fund. And so we're very fortunate to be moving towards our 4th fund in 2025. Fingers crossed that works out. But yeah, very happy with the results thus far. And hopefully we get to keep doing it.
Sounds like the right way to go about it. That's for sure. All right, let's get into our second question here. This is another question we received from a founder. The theme is thinking through founder market fit. And so here's the question. What's more important when deciding to invest, the founders or the market? Sean, do you want to take this one first?
I mean, it's a hard question because I think both of them matter, right? Like if you have a strong founder but a small market, they can only go so far. And if you have a weak founder and a huge market, they're also going to stall out at some point. I think in some ways, it's a false dichotomy. A great founder is probably not going to choose to work in a very small market. They're going to look for a big market with a big opportunity where they can take a big swing at it. So I don't find that choice very often. I do find that there are companies out there that are either too early or too late, meaning they're too early, they're working on something that's really compelling, but the market's not going to be ready for that kind of thinking or technology. Or the market arrived and a bunch of other companies have big advantages and it's unclear how you can enter that market. I find that is much more often a decision, that you can have a great founder and a great market, but they're either too early or too late, because the timing is so important. We venture capital works on a specific timeline, right? A venture fund might be a 10-year fund. And so you need these companies to be able to grow on that timeline. If you're too early and that turns into more like 15 or 20 years, that's tough. And if you're late and you can't show the growth that you need, that's also rough. So I think the timing ends up being a bigger problem than the founder or the market. I haven't seen that trade-off. Maybe, Ash, you have. I don't know. You've seen a lot more deals than I have, Ash.
Yeah, I want to take a step back here. So just thinking about it from an investor perspective, you are looking for a unicorn, and that is literally going to be incredibly rare. Every investor knows that. So almost everybody I know reviews hundreds, if not thousands of startups for every one individual investment or startup they might pick. So a massive market with a big opportunity to take advantage of that massive market is table stakes. An incredibly impressive founding team with a history of success or determination that measures up with their current, age, that is table stakes. In addition to needing a great idea, evidence that it might work, a pretty great demo, perhaps a bunch of customer discovery. And me and Sean are the very earliest stage folks. So we're the easiest to impress, and we still need all of those things. So I think that, most of the time when people ask questions like, oh, what's more important? I think you're missing the point of we're essentially looking for something so incredibly rare that it's less about perhaps those things being unique or special, but those are the baseline of what's required. So it's not founder or market, it's both and plenty more.
Fantastic. Why don't we hop into question 3 here? And I think this is right on target in terms of what you both were marching towards. So this topic is around unfair advantages. And here's what the founder asked. They said, what are examples of an unfair advantage that a startup can have?
So So I like to think about unfair advantages or defensible moats in startups across three categories. So there's tech, network effects, and user experience. With a tech advantage, you're talking about Google's search algorithm or ChatGPT's better model. Network effects, you're talking about Meta, those kinds of applications, TikTok. And then user experience, you're talking about maybe something like Dropbox, where it's just a better product versus other storage products, although that can often be based on tech or it's easily copied. Now, in terms of what I care about personally as an investor, I'm usually looking for a tech advantage. And that doesn't mean winning by collecting a bunch of data on a market that you've perhaps already won. That's less of a good story for tech. But those are the three. And as an individual investor, I focus mostly on just that first one, the technology advantage.
Ash, quick question for you. How do you, at the early stages, you're investing so early, the tech is probably at the very nascent stage. Like, how do you diligence that? Like, how do you make sure that tech is real? Because it hasn't been proven yet. It's easy to tell a tech works when it's at scale and it's clearly working. How do you diligence that? I'm really curious.
Well, you don't really. So what you're going to do is you're going to diligence the team, you're going to diligence the progress, and you're going to diligence the customer response. So if it's a high quality team that wants to build a technology advantage and they are attacking a problem that is real and unsolved, such that tech is a requirement and the initial responses from potential customers are positive, then I'm very much going to have to trust that they're going to be able to make the leap in terms of their ability to build that.
Gotcha. That's interesting. I don't disagree with those. I have found that as my career goes on, the advantage that I think matters the most is in distribution, is can you get your product in the hands of the customers who might use it or the buyers who might buy it in a way that everybody else can't. And at Near Horizon, that's one of the things we look for. We look for founders who have some sort of unfair advantage. Maybe it is they have a huge audience or a huge network of these, they know everybody in their space. And so if they build the product, they can sell it because everybody in that space who might buy it already knows them. There's lots of forms of distribution advantages. I've seen so many times that great, very smart people who know their market very well build great products. And then they're like, okay, now what? How do I get it out there? And the chance that you can build a go-to-market engine that scales as fast as you need it to without some sort of advantage starting out, it's just really hard. And I know it sounds difficult because especially for younger founders, how do you have a distribution advantage? And part of it sometimes is that you think about the market and you find an insight about how your product can work and how it might be sold. It's very different than other products. And that can become your distribution advantage where, software as a service is a great example where you could disrupt existing providers just because you weren't installing your software anymore. They could just rent it through a subscription. So there's many ways to have distribution advantages, but that really over many years, and the more I talk to repeat founders when they go out there to start companies, it's all about distribution. There's lots of smart people with lots of good ideas. Your edge and your success is on distribution. So do you have some sort of advantage or can you build an advantage in that world? I think that's the best thing you do for yourself, regardless of what investors think. Give yourself an edge.
On the distribution front too, that is something that allows you to, interestingly enough, the better your distribution, the less that you may end up needing an investor because you've got a business that can be able to already start scaling. And you, of course, become interesting to investors by demonstrating that your distribution works.
Wait, don't tell people they don't need us.
I said, on the rare occasion.
Hang on.
On the rare occasion.
Wait, where's the editor?
Oh, that's good. Just in case. Just in case. This is golden. Well, those questions definitely tie into each other nicely here, because if we're looking at founder market fit, so to speak, it seems like the theme, what you both are sharing here is, number one, you need both. So you need fantastic founders in a market that's ripe for an opportunity, but those are the table stakes. That's the foundation to spark some potential interest. And really the unfair advantages, as you all have listed here, are what you can use to really evaluate if they're a potential fit to work with y'all moving forward.
Yeah, and we were joking about it, but it is important to remember that venture capital is investing in a very specific kind of company that can grow extremely fast. And that is not most companies. And there are very many good companies out there that won't raise venture capital, and that's okay. And they'll build very healthy businesses on their own. Venture capital is not the entire market. It's a very narrow
Like
slice of the
Microsoft.
market. Yeah. Well, didn't they raise venture eventually? It was not at the first, but at some point along the journey, didn't they?
I think they bootstrapped the whole way. They were making money when Bill Gates was in high school.
There you go. There you go. So we should all be that lucky. But I mean, that's a journey. Like venture capital is one source of capital, just revenue is another. There's lots of ways to build your business. So just because you don't match what venture capital is looking for doesn't mean your business can't be successful, just in a different kind of definition of success.
Mm-hmm. Yeah, 100%. All right, let's do this. We got time for a rapid round. We have 3 questions here. We're going to turn it to Ash, then Sean for each. For
exciting.
Your responses, we'll aim for each to be about 15 seconds to these questions.
And just like in the Olympics, there's judges who will give us a numeric score based on technical and artistic performance, right?
That's exactly it. Yeah, you have to keep an eye on the episode notes and our social accounts to see what kind of scores come through on that one. All right, let's do it. First question. Do founders make the best investors? Ash?
Yes, in general, that is the pattern. However, Michael Moritz of Sequoia, one of the greatest investors of all time, not previously a founder.
Sean?
Yes, the data is very clear. The National Bureau of Economic Research has data on this. Former founders outperform non-former founders as venture capitalists by at least 25%.
That's awesome. All right, question 2. What's a clear signal or indicator from a startup that can make it interesting to potentially invest? Ash?
I'm always going to look at the team as the initial baseline. That's the start of any winning hand.
Sean?
I look for some really unique insight about a market because I find that you don't have a really unique insight about a market if you don't have a great team and a deep understanding about what you're going after. And so if you have that, it tells me you have a lot of other things too.
All right, fantastic. Third question. After 3 months of receiving the Near Horizon or Sterling Road Golden Touch, what's the change that a startup should experience? What can they now do differently? Ash?
We didn't offer anything to do with touching, just FYI.
Good distinction.
Yeah, just want to call that out in advance. But hopefully you're going to get a repeatable lead generation funnel.
Sean?
Yeah, with us, we're starting from zero. So hopefully you have a crystal clear initial customer profile, a problem definition, and you can be off to the races trying to figure out what the solution might look like.
That sounds like that's where we want to be. Fantastic.
Yeah, well, no, we all want to be on Ash's Island celebrating all of his success. But until that time, being on this podcast is the second best thing we can be doing.
I'm with you on that one.
Nice.
Yeah, if I had an island, let me tell you who the invite list is. It's small.
I think he's implying we're not on it, Nick. We'll follow up after the podcast.
Well, that's why you guys are the investigative journalists.
Okay, we're running out of time, guys. This was fun. I think the message to founders is there are new kinds of venture funds out there with very different kind of models. There are options. You should consider them if they're a good fit for your company. But for now, we're out of time. Ash and Nick, thank you for the insights.
Thanks, guys.
Yeah, thank you both. Absolute blast.
If you have questions we'd love to answer in a future episode, find us at thestartuphelpdesk.com or on X/Twitter at thestartuphd. All of our episodes are made up of questions that you ask, so ask more questions, we'll have more episodes. For now, the Startup Help Desk is closed. Good luck in building your business.